Today's Talk About It Tuesday question is, my financial planner asked me what my risk tolerance is so he could help me choose the right investments. If I've never invested before, how do I determine what my risk tolerance is? I think risk tolerance is one of the most misused and misunderstood terms in financial planning that exists, period. And let me just share a quick story with you, and then I'll get into what it is and really how to determine what your risk tolerance is. So when I was 22 years old, I got a great job. I was making a lot of money. I was single, no kids, and I said, I need to do something with this money. I need to get a financial planner because I have no clue. So I made an appointment with a financial planner. He came to my apartment, and he said he had a bunch of investment products he wanted to show me. He said, but before we start, I want to know what your risk tolerance is. Are you risk adverse, moderate, or aggressive? So I interpreted what he was saying as, are you afraid to invest? Are you somewhere in the middle? Or are you a high risk taker? That's the way I interpreted it, because based on the options that he presented to me, that's what I understood it to be. And I think that's what most people understand it to be when somebody says, what is your risk tolerance? Are you risk adverse? Are you moderate or aggressive? So being 22 and really not having any responsibilities and having a lot of money, I immediately said, I'm aggressive. I don't know if he cared what I actually said, because he didn't all of a sudden go in his bag and get a bunch of different products. He said, well, based on what you said, and he laid out, what he thought I should invest in. So it took me many, many, many years to really understand what risk tolerance actually means. So risk tolerance, I guess the term risk is what throws people off. It's really what is your ability to tolerate not reaching your financial goal, your investment goal, or to absorb losses, right? So it's really, because that's what the risk is. When you talk about risk in investing, right, you have a perception or an idea of what the investment is going to give you as a return over a certain period of time. And the risk that is involved is, one, you might not reach that number. So even though the time has passed, and even if the investment performs, it does not perform to the level that you thought it would. And so it falls short of what your goals are in your time horizon. So time horizon is the duration of where you were going to invest, how long you were going to invest to reach a particular goal. So risk number one is you do not reach the outcome that you desired within your time horizon. Risk number two is it does not perform at all and you suffer losses. And the losses to your principal, meaning you end up with less money than you started, right? So those really are the only two risks when we talk about risk tolerance, right? So the ability to absorb not reaching your investment goal in terms of a number, or to absorb losses. So how do you determine what your risk tolerance is? So first, let's look at your time horizon. So how do you determine your time horizon? So at the time, I was 22 years old, and my goal was to reach a certain age and not have to work anymore. So it was really about retirement, but it wasn't traditional retirement. I wanted to retire early. So in my mind, I had another 25 years, maybe 30-year time horizon to reach that mark, because by 50, 52, I wanted to be in a situation where I didn't have to work anymore. So I had a 30-year time horizon. So that's important, because that means if I lost a lot early, I had a lot of time to make it up. So that gave me a bigger cushion in terms of tolerance. I could tolerate losses along the way because I had a lot more time to make up the losses. So that raised my risk tolerance. Because I also didn't have a lot of responsibilities, because I wasn't married, I didn't have children, I didn't own any assets, a home, I didn't have anything to lose. That also raised my risk tolerance. I could tolerate things not performing, and I had nothing really to lose, nobody to hurt, nobody to harm except myself. So that raised my risk tolerance. So you have to look at those things, but then you have to look at the level, the amount of assets you have versus the amount of liability you have. So what are assets and liability? So assets are things of value. Liabilities basically are debts. So I didn't have a lot of debt and I didn't have any assets. But when you're considering this, you have to look at, so I'll give you an example. Years later, when my risk tolerance changed dramatically. So after I left my job, I was in my mid-30s, I acquired a lot of real estate. But I acquired all the real estate based on debt, right? Meaning they were mortgaged, heavily mortgaged. When the housing crisis happened, even though initially I had equity that I thought would give me a cushion if something went bad, I would refinance or I would sell and I would be able to pay off the debt and have cushion. When the housing crisis happened in 2006, all the equity, right, the prices went down, all the equity drained out of the properties. And so when I got into financial trouble at that time, I could not refinance because banks were not refinancing, and I couldn't find a buyer that would buy the property for what I even paid for it. So it was what we call upside down. So now at that point, my risk tolerance was zero. I could not tolerate any unexpected activity in the market. Because I was what you call over leveraged. I had way too much debt compared to assets in terms of value to assets. And so my risk tolerance was zero. I could not tolerate any risk. So you have to decide, do you have a lot of assets with value compared to the amount of liabilities you have? So if there's a problem in the market and some asset values go down or your liabilities go up, can you absorb it based on the amount of assets to liabilities you have? Or are you the other way around, like I was? Do you have a lot of debt, a lot of liability in relation to the assets that you have or the equity in the assets that you have? So if you have an adjustable rate mortgage, let's say if it's real estate, you have an adjustable rate mortgage and interest rates suddenly go up dramatically like they did recently, and asset values in terms of real estate don't go up but even go down, can you tolerate the increase in prices you're going to have to pay if rental prices don't go up, if that's what you're using it for? You also have to look at your risk tolerance, meaning are your asset classes well diversified? So if you had all your assets in real estate and real estate goes down, you're in trouble, right? You can't tolerate any risk in the real estate market. If all of your assets are in stocks, right, and the S&P 500 or the stock market is going down, you're in trouble. You can't tolerate any more risk. Even if you're in the stock market and you say, well, I only do tech stocks because tech stocks do well in certain economies, but then we go to a different economy and tech stocks tank because you weren't well diversified, you have no risk tolerance. So risk tolerance means your ability to absorb losses or your ability to make up for losses in your time horizon. So if things don't perform the way you expected or they do poorly, can you tolerate it without going under, and can you make up the difference? So when somebody asks you what your risk tolerance is, especially a financial planner, are you risk adverse, are you moderate, or are you aggressive? And they don't ask you what your situation is in terms of your assets and liabilities, in terms of what the losses would do, how they would impact your life, then they're just trying to sell you something. So really be careful about that. But when you're trying to consider, okay, should I take on this new opportunity? Am I already over leveraged, and does that make me more fragile? You have to consider that. When you're deciding what type of investment to do, and you say, well, I'm already heavy in this asset class, I don't need anything else in that asset class because that'll make me more fragile. Maybe I do a different asset class. So you move it around. So being well diversified, even within an asset class, right? So being well diversified in an asset class and then having multiple asset classes and making sure that your asset values are greater than your liabilities as opposed to the other way around, and making sure you have a certain amount of time that if you lost, you could make it up. That's how you dictate whether, what your risk tolerance is. It has nothing to do about how you feel about taking chances. It's all about the numbers. So can you absorb the losses? Can you absorb the risk? Can you make it up in a particular time frame? That's how you decide what your risk tolerance is. It has nothing to do with aggressive or moderate or risk adverse. It has to do with your ability to again, absorb losses and to make up for losses in a time frame, in a time horizon. So hopefully that clarifies that for you, makes it easier for you to understand. Forget how you feel about it. It's about what you can tolerate. So I'd love to hear your thoughts on it. Please like, share, subscribe, keep the questions coming, and I'll see you next Tuesday.